FOMC minutes out today. Will that ruin the bull market? That's coming up on 3 Minutes on Markets and Money. So as we've been talking about for the last few days here, markets have had an incredibly good run here, up 17% from the lows already. I mean, wow, what a transition from negative pessimism back here in late July to just uber bullish optimism now. Markets ran right into the 200-day moving average yesterday, looked to open a little bit weaker this morning. We'll see how the market plays out today. But again, first real test of resistance. Two things to really take a look at here today, importantly. One, the FOMC is releasing their minutes from the last meeting today. Now, what we need to be looking for there and what markets will be looking for is, has their stance changed in terms of the strength of employment, the peak of inflation potentially? Are they thinking about actually pulling back on their rate hike? So again, everybody's kind of looking for that dovish tilt towards the FOMC minutes today. If that comes out very dovish here, that could help, recover these early morning losses and help push the market up. Again, under anticipation that the Fed might be looking to stall rate hikes sooner than expected. But importantly, markets are now 2 standard deviations above the 50-day. Look, right now we're 9% above the 50-day moving average. We've stretched that rubber band historically a long ways here. And that typically, when you have this kind of a deviation, markets have a real tough time staying above that level for a very long period of time. And so eventually you're going to get a reversion back to the moving average or below the moving average. That's why it's a moving average. Prices have to trade both above and below that average over time. But you'll notice that each time that we're 2 standard deviations above the 50-day moving average, and we've done this many times in the past, that has typically preceded, depending on whether you're a trending bull market or a bear market, either one, it has generally preceded at least some sort of corrective action, either back to the 50-day moving average or back down to the lower band of that 2 standard deviations below the 50-day moving average, which have been better buying opportunities for stocks. So again, looking at where we are, a correction back towards that 50-day moving average would certainly give us a much better entry point to add equity exposure to our portfolio. That would also reverse some of this major overbought conditions that we have across the market as well. Now, importantly, it will be that stocks can come back to a level of support and hold that level of support wherever it is, the 50-day moving average, the 20-day, wherever it is. It's important that stocks hold that support. If not, we're going to be breaking down. Of course, this will be, the talk on the media will be the resurgence of the bear markets back, etc. But any pullback to this support level it holds, that'll be the buying opportunity, and will suggest that this current bull market is indeed still in progress, at least for the intermediate term. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.